Hi, I'm Adam, and in this video series, I'm going to be taking you through how to create your first client in Truth. So far in this video series, we've covered creating clients, inputting data on the fact find, working with the net worth, income, and expenditure statements, and inputting pensions. In this final video, we'll bring together everything we've looked at previously and look at how it forms our client's cash flow. We'll explore how Cashflow Tools can provide instant answers to many common client questions. We'll then see how easy it is to create hypothetical what-if scenarios to help clients visualize and understand their financial decisions. Let's get started. We can access the Cashflow statement from the Planning toolbar. The Cashflow statement is symbolized by blue and red bars, which represent the Cashflow capital chart we'll see in just a moment. This is Kath and John's lifelong cash flow capital chart. It shows their projected liquid capital now and for the rest of their lives. It doesn't include anything that's illiquid, such as their pensions, properties, or businesses. But it does include any income that they take from those pensions and the equity that's released when assets are sold. If our capital chart is all blue, this indicates that our clients can live their desired future lifestyles without ever running out of liquid capital. If the chart dips into the red, this indicates that, according to current assumptions, their lifestyle is unsustainable and there's work for us to do to help them achieve their goals. We can see the narrative that we've developed over the previous 3 videos represented in their lifelong cash flow. Between now and retirement, there's a period of gradual capital growth. At Kath's age 65, when they retire, the tax-free cash from their pensions brings their liquid capital up to £600,000. The income from their pensions lasts until around age 84, when it starts to tail off. As soon as this happens, we downsize their main residence, releasing enough equity to top up their cash flow and ensure they never run out of money. Beyond age 95, when we're assuming John's state pension is no longer paying out, the cash flow drops away a little. But Kath still reaches age 100 with over £400,000 in liquid capital. In many ways, getting to the cash flow statement feels like arriving at our destination. But in fact, it's just the start of our cash flow journey with our clients. As we progress through Kath and John's net worth, income, and expenditure, we've been validating all of the assumptions that comprise our model. We've given Kath and John the opportunity to disagree with these assumptions and adjust them if needed. By the time we reach the cash flow, we already have a pretty good idea of what it's going to look like. We know when to expect peaks and troughs because we worked through and built that narrative together. Now, it's time to start planning. The main aim of cash flow modelling is to help clients visualise their financial futures and the impact of their decisions. In Truth, we achieve this by using what-if scenarios. You can have up to 8 hypothetical what-if scenarios, but each client will always have at least one. To change the scenario, simply click on the Scenario drop-down list on the Planning toolbar. Note the currently displayed scenario is Current Position. If we look at our Cash Flow tab, we can see that this is the cash flow statement for the current position. In this client, our second scenario is called What If. If we choose this scenario, a second cash flow tab will open. This one for the What If scenario. To begin with, our scenarios are identical. We can check this by using the Overlay Chart tool on the Cash Flow toolbox on the left-hand side. The Overlay Chart tool allows us to overlay any What If scenario over our current cash flow capital chart. This can be a really powerful way of highlighting the financial outcome of a life decision or the impact of our advice to our clients. In this case, we can overlay the current position over our what-if scenario just to confirm that there are no differences. To remove the overlay, simply choose the Overlay Chart tool again and deselect the current position. Having confirmed that our cash flows are identical, we can now start planning in our what-if scenario. Kath and John know that they can retire at Kath's age 65 when John is 70. They would like to explore retiring earlier so that they can both enjoy a longer period of active retirement. The annotations at the bottom of our cash flow capital chart are our key dates. If we move these, all assumptions linked to our key dates will instantly and automatically recalculate. For example, by moving retirement earlier, we will end Kath's salary earlier. We will see fewer years' worth of contributions into her pension and fewer years' growth before we start to draw income from it. Where we've chosen sustainable or percentage-based pension benefits, these will not only start earlier, but generate less income for our clients. Where we've chosen fixed benefits, funds will potentially run out sooner. If we were to move retirement from age 65 to age 60, as well as adjusting salaries and pensions, we would also be making our period of active retirement start 5 years earlier. We also need to bear in mind that if our later life key date remains at age 85, we are effectively extending that expensive period of retirement from 20 to 25 years. Let's do exactly that. Now Kath and John's cash flow looks completely different. The period of accumulation at the start is much shorter. After taking tax-free cash from their pensions, they rapidly deplete their liquid capital during active retirement. At age 75, Kath's pension, which has fixed withdrawals, is depleted, leaving them with just John's pension and their state pensions to provide income. At age 85, when active retirement ends, their spending reduces and they downsize their main residence. Enough equity is released to keep them afloat for the next 10 years. When John's state pension ends, Kath's state pension isn't enough to fund her lifestyle and she runs out of money at around age 98. Just to highlight this change, let's overlay our current position. Note the retirement key date in the current position has remained at age 65. All our key dates can have different values in each of our what-if scenarios. Kath and John might be more than happy with having enough to see them through to age 98, but let's explore how some of the cash flow tools can help fix broken cash flows, answer common questions quickly and easily, and ensure our clients achieve all their lifestyle goals while never running out of money. The first tool on the left-hand side is the More Inflows calculator. This helps us answer questions like, how much equity do you need to release from your house? How much do you need to sell your business for? Or how much more do you need to earn? With all our cash flow tools, we can set a threshold. This is the level below which we don't want our clients' cash flow to drop. Let's set this to £50,000. We can make this as high or as low as we want, or simply set it to 0 to eliminate any red from the chart. Perhaps, rather than working full-time, Kath would consider doing some part-time consultancy work for a few years after retirement. To find out how much she would need to earn, we can choose Kath as the recipient of the income. As truth is calculating both clients' and partners' income tax position and allowances, we can sometimes get very different answers depending on who we choose as the recipient. Let's choose a regular earned income. We could also choose a tax-free income to find the net amount required, or a regular dividend if there was the possibility of increasing income from a private company. Let's assume that this additional income would escalate at 3%, our inflation rate for this model. The income would start at retirement, which is now age 60, and run through to age 65. Kath would need to earn £35,000 a year for those 5 years. Her current salary is £100,000, so this is definitely a possibility worth considering. We can click Show to overlay this hypothetical solution on their cash flow chart. If we decided this were our chosen solution, we could click Keep. For now, let's click Remove to reset our cash flow. Perhaps, rather than working part-time during retirement, we could look at increasing the equity released from their property when they downsize. If we choose a tax-free lump sum, which comes in on our later life key date, we would need a figure of around £260,000 in actual terms, or £100,000 in today's money. If we open up the net worth statement and fast forward to our later life key date, we can see that their main residence is worth £670,000 in today's money, or £1.7 million in actual terms. There are many other ways of fixing a broken cash flow. As well as increasing income, we could look at increasing investment return. The next tool on the left-hand side is our growth calculator. Once again, we can set a threshold for our cash flow, but this time we're asking Truth what growth rate, or how much additional return, is required to help our clients achieve their desired lifestyles. Let's choose all of Kath and John's invested assets, their unit trusts, and their pensions, and see how much additional growth is required. Often the results of the growth calculator are surprisingly low. The impact of compound growth over long periods can be dramatic. In this case, we would only need an additional 0.28% to prevent our cash flow dropping below £50,000 at its lowest point. Just to check, let's show this result on our chart. It's worth remembering that each cash flow tool is trying to fix our client's cash flow using its own solution in isolation. As well as just keeping or rejecting the calculated value from each tool, we could enter our own revised value, and all other tools would adjust accordingly. For example, if we were to override the calculated £35,000 from Kath's consultancy earning with a figure of £20,000, we might find the increased investment return required would drop to 0.1%, or vice versa. We aren't going to go through every single cash flow tool in this video. If you're interested in finding out more about some of these solutions, there's a playlist on our YouTube channel called Cashflow Tools, which goes through each in turn. But let's look at one final possibility for Kath and John, topping up Kath's pension before retirement. The pension toolbox gives us a range of pension tools directly from the cash flow. The DB transfer overlay tool allows us to simulate transferring a DB pension. The maximum contributions tool will calculate how much carry forward our client has available. In this case, we simply want to know how much more Kath would need to contribute to achieve a target cash flow balance. So let's take a look at the top tool, target a cash flow balance. First, we need to choose which year we want to target for. Let's choose the end of our projection. The current cash flow balance is displayed. Rather than minus £53,000, what do we want our client's cash flow to be at this point? Let's input a value of £1. We can make the additional contributions into any existing pension item, or use the tool to create a brand new pension. In this case, let's choose Kath's pension. The contribution can be paid personally or made by the employer. Of course, personal contributions will have an immediate cost to the client, but will result in a higher level of pension income later on. For now, we'll choose an employer contribution, from today through to retirement. The additional contribution required would be £700 a month, from now until age 60. This time, let's choose Keep. And there we have it. We've just created our first what-if scenario. We can use the overlay chart tool again to highlight to our clients the differences between their current position and our recommendation. Remember, we've only changed two assumptions between our scenarios: retiring 5 years earlier and increasing pension contributions. As a result, we have a really clear illustration for our clients of the impact of these two actions and the value of our advice. This is just one of an infinite number of hypotheticals Truth can model. We can create hypothetical items, or vary pension benefits between scenarios. There's a link in the description to a video covering some of these options in more detail. Truth also makes it easy to produce consistent, polished reporting output. There's a link in the description to a video showing how to produce financial plans for your clients. In this video, we've looked at how the cash flow statement pulls together the assumptions we've made with our clients about their net worth, income, and expenditure. We've explored how to use some of the cash flow tools to answer clients' questions directly from the cash flow. We also looked at how to use what-if scenarios to highlight the impact of clients' life decisions. Now it's time to put these concepts into practice with your own clients. Don't forget, our support team are on hand if you need any assistance. Thanks for watching.